All right, market sell-offs. Today seems so appropriate with the market again down today. We're in a situation where it seems like we sold off one day, up one day, down one day, up one day, down one day. You know, we had a bumpy ride last week and we're beginning to have a bumpy ride again this week. We're seeing prices increasing. We've seen an estimate that up to 30 states are experiencing a recession. It's very possible the recession will spread to the other states. We talked about that last week. That's what we talked about. That's what I had to say. A third of the people are doing very well. They're consuming, they're driving the economy. 2/3 of the people are struggling to make it meet in the US. 2/3. What that suggests is we're really in the early stages of stagflation. And maybe it goes away, but maybe not. Stagflation creeps along. It doesn't suddenly take off and go. But if you look at stagflation in the 70s and the 60s, the market dropped 20% as it was in the early stages and then rose back up to break even. Then it dropped 30% and rose back up. And then it dropped 40% when stagflation really began to roar off. But the difference between that period of time was 7 years. It took 7 years for the beginning of stagflation to really get going. We are, in every bit of indication, in the early stages of stagflation. So, we want to talk about that and see what's happening and what we do about it. The fact is, the reality is most people that are listening to this workshop, most people have a financial advisor, most people have a financial plan, most people are moving ahead with a financial advisor and financial plan. And what I want to say is this: if the markets are going to hell, your financial plan is going to safely get you there. That's the reality of the situation. That's what today's discussion is all about. We're going through this. As I mentioned, we're up and down, up and down, up and down in the market. Fortunately, we may be up and down, but the market is not going down more than it goes up. We're just bouncing around. And what you hear on CNBC, or you read in the Wall Street Journal, or you hear from Bloomberg, or whoever you're following, people don't really know. If you're working for CNBC, or if you're writing the articles for the Wall Street Journal, when the market takes a drop down, you look for something that explains it. You look for it. I mean, back in August of last year, on the first day of the month, the market took a big drop. That was actually August of 24. Market took a big drop on the first day and then on the second day. And on the first day, you had all sorts of explanation from the talking heads at CNBC who thought this and that. And Bloomberg wrote articles, the Wall Street Journal wrote articles. No one got it right. No one got it right. I've been in this business for 40 years and I'm not surprised at all. What really happened was the carry trade. That's where people were borrowing money from Japan, investing it in the US, taking advantage of arbitrage. And it was trillions of dollars, or billions of dollars rather than trillions, but billions of dollars wrapped up in that. It took a week or so for that to become obvious. So as we're going through periods of time, if you're listening to CNBC, if you're listening to Bloomberg, if you're reading the Wall Street Journal or Barron's or whatever it might be, know that those people are expected to come up with an explanation for what's going on in the market, and half the time it's going to be wrong. Half the time. That's the crazy market we live in. So what are we going to do? Stagflation is truly brutal. Look at the prices. There's no other way to say it. It is brutal. And it was the same in the 1970s. Through the 1970s, we went through the savings and loan crisis because the interest rates were going up, inflation was going up, inflation and interest rates were following that. Savings and loan were loaning long and borrowing short. They were paying people CDs, but they were loaning long at lower rates and having to pay higher and higher rates. We're seeing some of that same kind of craziness going on in the banking system today. And there was the recession side because during the 1960s, late 60s and early 70s, we were in a recession as well as inflation. And the time to recover, look at the prices. When you look at the inflation of the 60s and 70s, the inflation from 1961 to 79 destroyed 70% of the purchasing power, just looking at those first 18 years. But if you look at it in reality, look at this. 1960, a postage stamp was 4 cents, 1992, 29. That's sevenfold. That's not 70%, that's 700%. A Coke, 10 cents to 87 cents in 92. And look at the difference. In 1980, 35, that inflation continued in what we buy, even though the consumer price index said that inflation was solved. The reality is prices continued to increase. Gallon of milk, half a buck in 1980 to 18 continued to increase. Dozen eggs, 57 cents in 1980. 91, it had only doubled in a year, but it increased another threefold. If you look at what's going on in the 1960s and 70s, what happened is home prices came down and gas prices came down. Gas prices soared in the early 70s and they began to trickle down. So in the official consumer price index, it looked as though inflation was solved. If you look at what's going on today, talking about inflation, the inflation of 3% or 2.9 or whatever it is, looks like inflation is solved, or at least coming down. But if my wife is correct in going to the grocery store, prices are continuing to go up. If we're looking at the price of chocolate, Halloween candy, prices skyrocketed. I mean, prices go up like a rocket and come down like a feather. The 1960s and 70s, it took 32 years to work out of. 32 years. Last week I talked about being prepared for 16. It could be a lot longer. Could be a lot longer. So what are you going to do? Most people who have a financial advisor rely on a financial plan, and it makes you feel really, really good. It does. Financial plans, the markets may be going to hell, but that plan's going to get you there. And why do I say that? I mean, you put all your information into the computer and the computer comes out and says you have a low probability of running out of money. Is that really, really true? Is that really, really true? Your plan calculates the probability you'll outlive the money, but what if it's really wrong? What it does, what your plan does, is it uses a statistical method called Monte Carlo simulation. And you plug all the data in, you plug the returns in, you plug information in as to what you have as your nest egg and what your savings are and so on. And you end up with a probability. But the chances are, the probability is much, much greater. And why do I say that? My undergraduate degree was in math. My master's degree was an MBA, but my undergraduate degree is in math. And so I kind of understand what's going on. The Monte Carlo simulation is based on the normal curve. what mathematicians call the normal curve. It's what we call, in normal terms, we call the bell-shaped curve. You're familiar with the bell-shaped curve. It's called the normal curve. And it's really nice to work with because of all the points that go in making up that curve, how often they happen. 50% are above the average and 50% are below. We call that the mean, or the, 50% above, 50% below. 2/3 are within what's calculated to be one standard deviation, plus or minus. 95% within 2 standard deviations, 99% within 3 standard deviations. That's really nice to work with. It's really easy to work with. There's lots of formulas that can use it. And it's something that people use all the time. The question is it correct? Is it correct? One trillion, the number 1 trillion. If you had $1 trillion at the time of Plato, and you spent $1 million a day from the time of Plato, 2500 BC or whatever it is, if you spent $1 million a day from the time of Plato until today, you'd still not have spent $1 trillion. That's the size of 1 trillion. So one example for how the normal curve, the bell-shaped curve, doesn't work is the crash of 1987. Remember, on one side of the curve, 3 standard deviations means 99% of the time the returns are within that 3 standard deviations. The crash of 1987 was, I have to look and read it, 20 standard deviations, not 3, 20 standard deviations. And what's the probability that would happen according to that bell-shaped curve? It's 275 chances in an octovigian trillion. What's an octovigian trillion? That's a 1 followed by 87 zeros. 1 trillion is 1 followed by 12 zeros. Think about it. An octave in a trillion is 1 followed by 87 zeros. The probability of something like 1987 happening is so completely off the charts, no one figures it out. But that was an unusual thing. How about a 20% crash, like we went through in COVID or the Great Recession? According to the bell-shaped curve, you know what the probability is? That should only happen once every 111 years if the bell-shaped curve was good. Which means that in your lifetime, we should not see another 20% down. Because we saw it, you can either take 2020 or you can take 2008. But even if you take 2008, that means it shouldn't happen again until 2119. Are you going to be around in 2119 to see the next bear market? That's what that bell-shaped curve does. That's what most people with their financial plan are living with, is something that forecasts we're not going to have another recession, another bear market, I should say. We're not going to have another bear market for another 111 years. Believe that? Do you? That's, for me, that's one part that makes it really, really bad. What that really does is when you look at it, the chance that you'll run out of money using Monte Carlo simulation, it's painting a really nice picture. Paints a picture that if you just follow the plan, put in with your nest egg, put in with your savings, you're going to be just fine. No, you're probably not going to be just fine. That's Monte Carlo simulation. That's a key part of financial planning, is to know if you're going to run out of money, if you have enough money. If you don't have enough money, how much do you have to add? That's Monte Carlo simulation. It's dead wrong. Dead wrong. Secondly, your advisor probably believes in modern, if you get a plan, it's modern portfolio theory. Won a Nobel Prize. It's built on assumptions about how the market works that aren't true. Asset allocation actually reduces returns, not protects you in down markets. Think about it. I've heard it explained that it's like an elevator with, would you rather have an elevator with one cable or four cables? Doesn't it seem safer with four cables? Yeah, with that picture, it does sound safer. But what if all four cables fail? You know, if you listen to what most people who are doing financial planning and setting it up, they'll tell you that when one asset goes down, another goes up. Didn't work in 2008. Everything went down with the exception of cash. And we had low inflation, so cash held its own. Stocks went down, bonds went down, real estate went down, commodities went down. That's what happens. And we are in the beginning stages of stagflation. You know, and even in normal times, think about it. If stocks return an average of 9% and alternatives 7% and bonds 5% and cash or short-term treasuries 3%, add those together. 9 plus 7 plus 5 plus 3 is 24. Divided by 4 is 6% versus 9% just in the stock market. And if you take the 6% less 1% that the financial advisor charges, you get 5%. And if you've been listening to these workshops, if you've listened to some of the ones in the past, if you look at the chart at the end of this presentation, it shows that the average financial advisor is producing 5%. And those are during good times, during normal times. You know, asset allocation during good times, and a financial plan will give you 5%. During bad times, it could be negative. I remember going through 2008 and hearing the stories of retirees who had to cut back their income, retirees that had to go back to work to supplement their income, people that were planning for, I know one couple that was planning to go, their children to go to USC because they both had graduated from USC. They had the money essentially set aside. Their children went to Washington State. Not that there's anything wrong with Washington State, but it was a whole lot less expensive than USC. But 2008, just simply everything caved in. That's not where you need to be. Secondly, rebalancing. Selling your winners to buy your losers sounds smart and disciplined. People paint the picture of driving down the road and weaving in and out of traffic. And yes, I do weave in and out of traffic. In volatile markets, in any market, the other side of that is to let your winners run and cut your losers short. There's the rebalancing that goes on in financial plans is mostly done because people don't know what the winners are and what's running on. But there's another part of it as well. And that's the data that you use to get to that. The average stock return from 1928 to 1924 was 8.55%. Stock return, 1928 to 24, those 96 years, the average was 8.55. Or if you look at just the last 30 years, it was 10.49. If you look at just the last 5 years, it was 14.25. Or if you look from March 2000 to March of 2009, it was minus 6.9%. Bond yields have varied over the last 50 years from 2% to over 17%, depending upon the time you look and the assumptions you make. What about inflation in a financial plan? Inflation is seldom built into a financial plan to see inflation take off. And remember, we got to 13% inflation in the late 1970s. Will we get there again? I don't know, but I sure am planning on it could happen. 13%, and it didn't go there very quickly. Inflation in 1961 was 1%. By 66, it was just 4%. By the early 1970s, 1971, 72, it was still 4 or 5%. And then it began to take off and go. Do you build that in? You know, the difference between assuming 8 and 9% over 20 years is a difference in a nest egg of 19%. Even in normal times, picking the right numbers is arbitrary. Do you pick 1928 to 24 for 8.5%? Do you pick the last 30 years at 10.5%? The last 5 years at 14.25%? You know, that's we saw in that period of time until 2008, from the 1930s to 2008 was figured the golden age of economics. In the 1930s, we passed FDIC. There were not going to be any more bank panics. That was the belief that happened until 2008. But things that happen, things that have never happened before, happen all the time. We lived through 2008. We had bank panics. We didn't call them bank panics. We call them systemic events. But indeed, that's what happened. Rebalancing is wrong. Asset allocation doesn't work. And what you choose as your data to build into your plan makes the difference and can make a difference of 20% just by 1%. It makes a difference. Which brings me to what firms say. I lived in the large brokerage firms for 18 years. That's where I spent my first 18 and a half years of my time since I licensed and began to manage client accounts. I lived in those firms. And the mantra there was for financial advisors, sell the relationship, not the performance. Yes, every situation is unique with reward and risk. And it's a lot easier to make people like you than to actually deliver performance. It wasn't really helping the clients when you produce 5%. The average financial advisor, 5%. But don't show that. Don't publish it. Don't show it. And have quarterly returns. Keep a lot of contacts going with clients and convince them that financial plan is really working. Even the financial firms know it doesn't work. During that period of time of 2008 and 2008, 2007, during the Great Recession, when the Monte Carlo simulation blew up and people were not getting what they expected out of their financial plans, the great gurus and mathematicians at the major firms decided to do fat tail distributions. So the probability of those extreme events happening, the probability would be much larger. A fat tail curve, as I said, The bell-shaped curve in math is called the normal curve. It's one of the curves from what are called mathematically the Cauchy distributions. The Cauchy are always the same shape. Half of the observations or half of the data are on the high side of the average and half are on the low side of the average. It's just a matter of the standard deviation changing. And so what you end up with is having a greater probability or a greater chance of something happening on the negative side. And that has to be balanced with something on the positive side. Can you imagine a return like 1987, the opposite? The probability of that happening is 275 followed with 87 zeros. Probably not going to happen. Although at the beginning of the story, I talked about Ronald Wayne. He probably, that $800 is probably way out on that curve. Anyway, there's an old study that was done, 2010, 2011, Jackson National Life financial advisors, ask a large number of financial advisors, how do you think you do compared to the Standard & Poor's? 75% said, I outperformed the Standard & Poor's. 75%. Ask a room full of people, how many people in here are better than average driver? You know, I'd hold up my hand. But is there any data to support that? I don't know. There's nothing, no data. But there was data for the average financial advisors because Cerulli and Associates, taking that information, actually looked at how those advisors had done. They were talking about the data from 2010 to 2011. That was coming out of the Great Recession when the markets were flying high. And what Cerulli and Associates found is that the average for financial advisors, the ones that thought they were getting 75%, thought they did better than the S&P 500, they found their average was 4%. The Standard & Poor's 500 during those years was up 17% per year. You know, we happened to have a very good time coming out of the Great Recession. We went in earlier than the Great Recession and saw our accounts down in the beginning. We saw things come out even better because of 2010, 2011, we were up 27%. 2 good years, higher than average. But there are studies that show how the financial advisors do. The firms maybe not publish those numbers. The advisors are not publishing those numbers. But there are studies that are being done by Investment News, by Schwab, by BlackRock. Those studies are public studies. You can find them if you look for them. And the numbers that I put on the graphs at the end of the time are based on those studies, an average of 5%. We do a little better than that. You know, the other thing that's going on is everybody can read about the Great Recession of the 1920s. You can look at history books, they cover it 1929 in detail. But reading about it doesn't really prepare you for watching it, your own portfolio disappear. Remember, most of us have lived through the 2008 time period. You can read about that in books. And I have grandchildren that were very, very young in grade school. Some even beyond that into middle school. They read about it. They can tell you a lot about it. But until you live it, and it's your neighbor that's being foreclosed out of a house, your neighbor that's losing a job, if you're working for a company and you're fearful of losing your job, it's living through those times that makes a difference. You know, and I talk about you can talk about those times and getting through those times, and you can talk about a financial plan getting you through those. They don't. You know, when I started Adams Financial Concepts, I thought I was going to have to do financial planning. I thought I was going to do financial planning. It was the big thing sweeping the world. And so in 2005, I went out and bought the most sophisticated, the very best financial planning program you could buy. I think it cost $5,000 for the software. Maybe it was more than that. I sent my administrative manager to a 1-week course on how to apply it. It was $3,800 for the week, plus the hotel, plus the meals, plus the travel, and so on. Got it all ready to go. Had a client that had a kind of complicated situation, not that complicated, but kind of complicated. I produced my first financial plan. It was 400 pages long, around 400 pages. It was beautiful. Had pie charts and line graphs, bar charts, all the colors, had mathematical formulas, which I really like. Page upon page information. Some was just history. Some was client specific. Some was predictive. It was a beautiful report. It was beautiful. And I really felt, as I looked at that report, that I got my money's worth. And so I took it home to prepare for the client meeting, and what I saw, going page by page and looking at it, I was horrified. I was stunned. I was depressed. I looked at that report. I looked at Monte Carlo simulation and realized it's predicting market returns to be following the bell-shaped curve. I knew that was false. Bell-shaped curve. They don't follow a bell-shaped curve. They follow maybe a bimodal curve. They follow some other curve. It's always skewed to the right. That was wrong. I looked at the asset allocation and realized that's wrong. I looked at where you assumed the data began, and I knew by changing where the data began, I could change the results of Monte Carlo simulation. I knew all that. I looked at it. You know, people depend upon those financial plans for their financial future. And I looked at that. When I did the client presentation, it was 38 pages that I gave. And most of that was just client information, illustrating client information. It just wasn't real. You know, and it brings me back to the question about, maybe let me ask 3 questions. Since I'm talking about questions in math, let me ask 3 questions. And maybe you can put the answer in the chat. If a bat and ball cost $1.10, you know I'm a baseball fan. If a bat and ball cost $1.10, and you know that the bat cost $1 more than the ball, how much does the ball cost? That's question 1. Question 2, if it takes 5 minutes for 5 machines to make 5 widgets, how long would it take for 100 machines to make 100 widgets? Think about that. Put that answer in the chat. And if in a lake, if there's a patch of lily pads, like Monet painted, and every day the patch doubles in size, it takes 48 days for the patch to cover the lake. How long will it take for the patch to cover half the lake? How long will it take to cover half the lake? If it takes 48 days for it to cover the lake, how long will it take? So I ask the questions because they are kind of trick questions. If the bat cost $1 and the bat and ball together cost $1.10, most people will look at that quickly and say the ball cost 10 cents. Not true. The bat cost $1 more than the ball. You know what? The ball cost 5 cents because the bat cost $1 more than the ball. The bat cost $1.05, the ball cost 5 cents. So the bat cost $1.05, the ball cost 5 cents. If it takes 5 minutes for 5 machines to make 5 widgets, how long would it take 100 machines to make 100 widgets? 5 minutes. I got it. And if there's a patch of lily pads, and every day the patch doubles in size, it takes 48 days for the patch to cover the lake. How long will it take? How long did it take to cover half the lake? 47 days. Because the last day, it covered the entire lake. It had covered half the lake up until that time. That's because when you think about those questions, you think about it, and I think about those questions in terms of a financial plan, because a financial plan looks so wonderful, sounds so wonderful. You know, the reality is the math doesn't work. The math just doesn't work. And as I said before, managers can read about stagflation. They can talk about stagflation. They can talk about it in business schools. You can talk about it with financial plans. You can talk about how things will get through. You can plug in higher inflation numbers. You can plug in different data. But the fact is, statistically, financial plans are completely wrong. It's not the easiest way to get through it. What is the best way to get through? In my opinion, it's this. Would you rather have, if you start with 500,000 in 2009, would you rather have 5.4 million or 500 or 1.2 million with a financial plan? This is where the financial plan will get you. This is where we've been able to get our clients. And you don't have to be there. You can be here. You can be there. You know, it's all about getting through this whole process. That's what this is about today. Financial plans, I've been there. I've seen it. I've seen what happens to people. But I've also seen what happens with stagflation. I had a client, a widow, who came to me in 1986. That's when I licensed, and she was one of my first clients. Her husband had died in 1978. Christine was her name. Husband died in 1978. They had an insurance policy to cover his life. And so with the insurance policy, she was able to replace essentially most of his income with her pension and with her earnings. She was able to get by very nicely in 1978 and even into 79, but things began to go south. By 1986, the amount she was getting in income, she needed 2.5 times as much because the purchasing power had dropped by 40%. And the bonds that she had in 1978 and put in, those bonds had been, a number of those bonds were already called away. And instead of getting double-digit returns on the bonds, she was getting single-digit returns at half that. That meant she was on her way, Christine was on her way to running out of money a long time. She was just, in 1986, she was just 66 years old, and she would live to age 90. She would have run out of money in the early 90s had she continued on the plan she had. She actually maintained the same quality of life and had some money left over when she died to pass on to her children. You know, that's the difference between being on this curve and being on this curve. Where would you rather be? This is where my clients are. Yes, we take a greater volatility. You can't have higher returns without higher volatility. Maybe you can reduce the volatility some, and we should have reduced it in here. I wouldn't take that kind of drop again. I have some things we would do differently. But where would you rather be? Where would you rather be? There or there or there? That's what this workshop is all about. That's what this podcast is about. Where would you rather be? And with that, Of course, there's always disclaimers that past performance is no guarantee of future performance, and there's a lot of disclaimers. You can find all those disclaimers on my website as well. And with that, I'll open it up to questions and discussion. What would you like to know?
Hey, Mike, I'm back. That was super informative. Thank you very much for all of that you shared. Mike, first thing that came in was a comment that you might want to discuss, which is where most people make a mistake is that they look at inflation, but they don't look at the cumulative effect of inflation, and they concentrate on year over year inflation only, which seems to be right in line with what you were talking about today. Can you address that? And by the way, before Mike gets to that, I am watching for
Uh,
questions to come into the chat or the Q&A.
I, yeah, I think that's the slide. If I go back and look at this
This came in
inflation of the
even
60s and
before you got to
70s,
this slide, Mike. So
huh?
the comment came in before you presented this slide.
Ah, okay.
Yeah.
True. I think it's a very valid point, a very, very key point is inflation during this period of time never got much above 13% in any one year. And if you look at the average inflation during this period of time, the average inflation was around 6.8%. You know, the fact is, look at what the prices did. Good point. Excellent point. Um, you know, you see some drops, but not many. So hopefully that answered that question.
Mike, they also shared a link that shows the cumulative effects of inflation. That's in the chat if you wanted to click on that and discuss it. So if you look in the webinar chat, you'll see there that there is a link that shows a chart with the cumulative effect of inflation, if you want to show that. And if not, that's something we could probably
Um,
bring into, yeah, could probably bring that into another presentation. Let's see, I'm just going through the chat real quick. So, Mike, this is a question a very similar question to what we get every week. Somebody's asking what they should do with their portfolio based on um, the possibility of stagflation. And that's one of those questions where, Mike, I'll let you take this, but this is a presentation that's for a general audience. And Mike, you deal with people in unique situations.
so if you look at what happened during the period of time of the 1960s and 70s, stocks didn't do well. 1966, the Dow was 1,000. It dropped 20% back to 1,000, 30% back to 1,000, 40% back to 1,000, 20% back to 1,000. And by the fourth time, it was 1982, 16 years later. Stocks in general didn't do well. If you'd had an index fund in that day, you would have broken even. If you had invested in 1966, you'd just break even by 1982. Bonds, of course, were terrible. In the 1980s, mid 80s, bonds were a wonderful buy. You could buy bonds at 40 cents on the dollar. Um, commodities were interesting because commodities during that period of time, the dollar was connected to the gold, uh, $32 to buy 1 ounce of gold. And Nixon decoupled the gold from the dollar or the dollar from gold. And gold prices actually soared from $32 an ounce to 800 an ounce and then started falling back again. Real estate did okay during that time, but then it was the time of the baby boomers. And, that was kind of my generation. And we were young, graduate from college, get married, have a house, get a job, have a house. Things are different with my grandchildren's generation. They really make an analysis of whether to rent or to buy, and they're not rushing into it. They don't see the future as owning a house and raising children. I have questions whether residential real estate will hold up. We saw actually in 2008, residential real estate crashed. It probably will happen during stagflation times. All that's painting a negative situation. What did work? What did work is to find companies which were making a difference in technology, demographics, and lifestyles. One of one of the companies that did very well came public in 1966. Most people for restaurants went out and people took an order, put it in the kitchen, and brought the food out. This company had a concept of having no place to sit down, of having preparing the food in advance so that they had all the food in advance, and having people drive through and pick up their 19-cent hamburger and French fries. Of course, that was McDonald's. 10,000 invested in 1966. By the 1980, during that tough period of time, 10,000 would have grown to 100,000, would have grown 100-fold when the stock market didn't move at all, or only moved down and up. There was a company that was a radio repair shop, a little radio repair shop. Remember, in those days, radios and TVs had tubes, and if your radio went kaplooey, you took it to the repair shop and they would check the tubes and replace the tubes that were bad. Same thing with the TV. TVs were huge in those days. TVs were expensive in those days. But you took it to a radio repair shop or a TV repair shop and they would check the tubes and replace the tubes. And that little company in Colorado realized as the transistors that were coming out in radios was something that was truly a change in technology, and they became a major distributor of electronic parts, beginning with the transistor. 10,000 invested in that company in 1966 would have been worth 200,000. It grew 20-fold. Advanced Micro Devices came out with random access memory, company that's been around a long time. I actually invested in it. It's a bad story, a bad example of of my early days of investing. I bought the stock at a little over 10, sold it at 36 months later, and for 14 years, thought I had done incredibly well to have tripled my money in 6 months. It was then that I looked at how Advanced Micro Devices had done, and that $10 price stock would have been 1,756. Not such a good deal. I tripled my money. I could have made it 175 times. So there will be places to invest. There will be places to invest. It will be, in my opinion, a stock picker's market. Passive funds, index funds are probably going to get killed in stagflation. Active managers will probably do well, especially if they're good. If they're not good, they're not going to do well. Anyway, it's a long answer to a short question. Sorry, but that's.
Again, I think it's also important to note that, if you have specific questions about the moves that you should be making, those are best made through, directly with Mike, and I've included his email address in the chat. So you can reach him directly at that email. He reads and answers every single email he gets. So if you do want to have a conversation with him, you can certainly do that. And then I'm also going to put another link into the chat right now. This is the YouTube channel. And we take these recordings and put them up on YouTube every single week. So while it's always to your advantage to be here to get the information first, by Monday of the following week, we'll post this up on YouTube. So you can watch previous broadcasts as well. And Mike, with that, we don't have any other questions. Mike, I have a question though. What's coming up next week?
Next week. The last 2 weeks have been pretty dark. And not very positive. So coming up next week is the light at the end of the tunnel is not a train. It'll be a more positive outlook. And the fact is, the last 2 weeks, and I apologize for last week, we usually record. I started the the workshop early and I turned off the record button and forgot to turn it back on. So the recording is not there for last week. It was a negative week. This week, I think, is still pretty negative. So next week, there is light at the end of the tunnel, and it's not a train. I believe I'm an optimist, and I find the last 2 weeks have been really pessimistic. I don't want to, I don't want, you know, I'm optimistic about where we go in the long term. And I'm optimistic about those people that really understand what I said last week and understand what I said this week can really do well. And for them and for you, the light at the end of the tunnel is not a train. There will be some people that
Mike, if it helps you sleep any better, the conversations that I have in the chat, no one's calling you a downer for the last 2 negative weeks. So I think you're okay. You're safe. And next week we'll really reclaim the positivity train.
so
And so, Mike, with that, there are no additional questions here. So you guys who everybody stayed for the whole thing. I'm really grateful for that. Thank you for hanging out with us.
yep.
Mike's email's in the chat. The YouTube link is in the chat. And I thank you for being here. Mike, as always, you get the final word.
Well, thank you for being here. Hopefully you come away with information that you can use and make money with. Make money in up markets, make money in down markets, make money in flat markets, and enjoy a quality of life for the rest of your life. That's what this is about. So with that, have a very good week. I will be back next week with the light at the end of the tunnel is not a train. Have a good week. Bye-bye.